Hi everyone, my name is Annie Nichols and I'm the Agricultural Support Manager for the High Desert Food and Farm Alliance. For anyone not familiar with our organization, we are a nonprofit located in Central Oregon, and we support a healthy and thriving food and farm network through education, collaboration, and inclusivity. We cover the tri-counties of Central Oregon, including Crook, Deschutes, and Jefferson, as well as the Confederated Tribes of Warm Springs. Today, we will be talking about different crop insurance options for small and mid-sized farmers and ranchers. This is our main kind of constituency and partnerships, so we hope this will be applicable as well as a resource down the line when people are thinking about which policies might be advantageous for them. So today we are joined by Ben Teal and Lacey Manasco. They are both risk management agencies covering the Pacific. And then we also have a good number of folks from the Northwest Farm Credit Services, and we can introduce them if you're looking for an agent later on. So we'll start off hearing from the Risk Management Agency, and then afterwards we'll have an opportunity for questions and answers. You're welcome to put questions into the chat as we go, and then we'll just get those answered at the end. So with that said, thank you so much to Lacey and Ben for being here today, and I will pass it over to Ben to start us off.
Good afternoon, everyone. I may not be appearing on video. I'm not sure why. Maybe it's because I'm sharing my screen. Annie, can you still confirm that my presentation is being presented is on screen? Okay. So Annie, thank you for that introduction. So we're going to be covering some, I guess, relatively new crop insurance products that might be tailored to you all for small and mid-sized farms. So the topics to cover today, so the objective of our presentation today is to make you aware, again, of new products and specifically Microfarm Policy. However, to talk about the Microfarm Policy, we're going to first cover the Whole Farm Revenue Protection Policy, which forms the basis for the Microfarm Policy. Essentially, the Microfarm Policy is Whole Farm Revenue Protection Insurance, but insures only those operations which have $100,000 of revenue or less. And because of that, it has reduced record-keeping requirements, while Whole Farm is more tailored for larger operations, which can cover up to $8.5 million in revenue. We'll cover the general features and benefits of this insurance product, but like all insurance, there's a cost. The actual individual cost-benefit analysis can be done on your own, or you can seek out a crop insurance agent to get actual quotes. We'll cover more on that later. So topics to be covered, we will cover the basic principles of what is federal crop insurance in the whole farm. Then Lacey will take over, or that's the part I'm going to cover. Then Lacey will take over and talk about Microfarm more specifically, what it simplifies from the whole farm-based policy, and kind of things that are different than. So who are we and where are we from? As Annie mentioned, she gave our names. I'm the actual regional office director. Lacey's the deputy director. We work out of an office in Spokane called the Spokane Regional Office of USDA Risk Management Agency. The Risk Management Agency administers federal crop insurance programs, and our kind of sort of a function of our office is do outreach to help farmers choose effective risk management tools to achieve financial stability. And we serve specifically states of Alaska, Idaho, Oregon, and Washington. So crop insurance has a unique delivery system through public-private partnership. The public side being the government through RMA is responsible for developing and maintaining federal crop insurance policies. This includes determining the rates, prices, and yields for each crop at the county level every year. RMA is also in charge of doing compliance to prevent fraud, waste, and abuse. Now the public side comes in, or the private side comes in through independent crop insurance agents, sell the policies to the farmer. That's who the farmer will engage. So we don't sell anything. It's the agents work with sort of the selling of the policies themselves. And they sell those policies through approved insurance companies that underwrite the policies And if there's a claim, they settle the claim with their loss adjusters. The federal government on the public side also subsidizes the premiums to reduce the cost of crop insurance for farmers, and also reinsures the private insurance companies to share in the cost of the policies themselves. And crop insurance on the federal side is considered multi-peril crop insurance. It only exists in this form through the federal government. There is no multi-peril crop insurance that exists solely in the private sector. The reason being is it would be too risky, and without subsidy, it would likely be unaffordable and producers wouldn't purchase it anyway. Why should you consider getting federal crop insurance for your farm or ranch? It may help you stay in business after severe weather events, low production years, or low prices. It also provides some financial stability and may improve access to credit. This is something that's very important in the Midwest. Most financial institutions now will not lend to farms unless they have crop insurance kind of as a form of collateral. It's not as prevalent out in our region, but I think there's sort of a migration to that. So that's a little bit of kind of basic theory about crop insurance. Not sure sort of what is the makeup of our audience from the producer side, but sometimes I like to kind of, from the general side, somebody that's not familiar with crop insurance, I try to give them a little bit of what is crop insurance first, or why crop insurance. Now to get more to the subject at hand, talking about whole farm revenue protection, the first part of that is to say, what does whole farm mean? Whole farm revenue protection is available nationwide
Extension.
and ensures all commodities produced on your farm, with a few exceptions like forestry and animals for sport or show. Coverage is based on your allowable revenue taken from your federal income tax returns for farming. So that's kind of something I would say is very unique. Most crop insurance is based on your individual yields and your records of your historical production for yields. There are also area-based plans as well. But this is kind of a different concept where it does have foundation in your individual yields, but the record keeping part of it is in your federal tax returns. What does revenue mean? Well, whole farm protects against loss of revenue from all commodities produced on your farm. This includes decline in production, price, or quality from unavoidable natural causes. All crop insurance is based on causes of loss from natural causes. It's not based on anything it's human caused, whether it's theft, larceny, business interruption, those various things. Crop insurance does not cover that. Crop insurance is multi-peril, being that it covers for natural weather events like frost, hail, too hot, too cold, and also price declines. There's also with whole farm provisions for replant, and also if you're unable to plant due to an insurable cause of loss. So what is the incentivication for crop insurance, since there's a cost to it? It's not a free program. Well, the incentivication is that the government subsidizes crop insurance. And in this case, whole farm has a relatively substantial subsidy involved with it. This chart shows the percentage of subsidy the government pays based on coverage level and the number of commodities the farm has. So where whole farm, you're insuring all the commodities on your farm. This policy is sort of tailored for farms that are very diversified. The more diversified you are, likely the less risky you are for insurance purposes. So that's why we talk about the number of commodities you produce on your farm, and why there's more subsidy being applied the more commodities you have. So if you have 2 or more commodities, you qualify for higher coverage levels being something you self-select as the insured producer, and it's a form of deductible. All forms of insurance have a deductible, and this is how crop insurance applies a deductible. So if you're at 85% coverage level, essentially you have a 15% deductible. There's before insurance starts paying, you're having at least a 15% loss. After that point, insurance is paying out. With three or more commodities, that's when you get eligible for the 80 and 85% coverage level. The 2 commodities allows you for the higher premium subsidy. So for example, if we look at this table and you look at 75% coverage level, when you get down to 2 commodities, you're at 80% premium subsidy. That's what the government is paying. The government is paying 80%. That means producer premium is 20%. If you had crop insurance and you got a crop insurance premium bill, you would see these numbers, but then you would have to pay the 20%. Doesn't mean it's not free, or whatever your opinion is, relatively cheap, but that's the difference between it being insurance being available this form versus available in the private sector. Again, this policy is tailored to being diversified. So on top of the premium subsidy the government provides, there's also sort of the rating component of where you do it's the function of risk for what insurance costs. So the more commodities your farm produce, the more diversified you are, the less risky you are to insure. That is recognized in this policy with what is kind of a diversification discount that gets applied. Again, this is something kind of more in the background, but just to make you aware that it is recognized and acknowledged under this form of insurance, and will reduce your overall premium the more commodities you produce under whole farm. So when can you sign up for whole farm? There's a sign up period between the contract change date, which is August 31st, and the sales closing date. The sales closing date can vary depending on where you're at. In the case of Oregon and all of the Northwest, the sales closing date is March 15th. So you could sign up for whole farm or microfarm today or tomorrow. March 15th would be the last day you could sign up. What about other federal crop insurance policies? What is unique about this? Since you're insuring all the commodities on your farm, there is the option to purchase this as a standalone insurance product, or you can also purchase it bundled together with individual crop insurance policies along with whole farm, or you can also combine it with an FSA product called NAP, your non-insured crop disaster assistance program. And so for some producers that produce commodities that we don't offer insurance products for, you may have some familiarity with that. Whole farm is something where it's highly utilized by tree fruit producers. For example, most apple producers will take the apple policy, which only covers yield loss and not price, and they'll tend to take this at a low coverage level to cover spot catastrophic losses, and then they'll bundle whole farm with this, usually at higher coverage levels to cover, again, yield, but also price decline, since it's a revenue product. Since by doing this, you're going to have some overlapping coverage where there could be some offsetting losses, and that's recognized where there's offsetting premium costs. And typically, I think most people have become, or at least for agents have become fairly savvy at working out cost comparisons or cost quotes where you can do this bundling, where you can get insurance both ways and not pay much more additional premium for doing that. So there are some eligibility requirements for whole farm. To qualify, you have to be a U.S. citizen or resident. You have to be eligible to receive federal benefits. You have to also file a Schedule F tax form and have 5 consecutive years of federal tax returns and be in the business of farming. Now, there is one exception on the 5 consecutive years of federal tax returns. That's in the case if you were a beginning or veteran farmer rancher. And so you have farmed less than 5 years, but you have at least 3 years of farm tax forms, and then have also earned revenue in essentially 4th year, which we would call the lag year. You would potentially have eligibility for whole farm as well with having less than 5 years. And on top of that, we recognize or we incentivize new and beginning farmer and veteran farmers by applying another 10% premium subsidy on top of what the government provides as premium subsidy. So in that earlier slide, we saw 80%, it would turn into 90%. So what information do you have to provide? As part of the whole farm application, you need to provide your insurance agent 5 years of Schedule F tax records for your farm. You also have to kind of work through a farm plan for the upcoming year with what you will produce and the expected values and information regarding commodity inventory or accounts receivable and payable. I also mentioned about filing a Schedule F. If you don't file a Schedule F, maybe because of your entity status for tax filing purposes, I think this is applicable to some corporations, then your farm tax forms plus supporting information to complete a substitute Schedule F can also be performed. So as we go through this, and I'll later on have examples of kind of a simple example of sort of how the guarantee is calculated. And so this will kind of make more sense of how this policy works. But as we sort of work through this, kind of setting the stage for whole farm, I think can be for highly diversified farming operations, whole farm, I think is a very good risk management tool, but it has a lot of complexities and record keeping requirements. And that's where sort of the microfarm part of it for very small farms sort of, I think, alleviates some of those complications. So what is my whole farm revenue coverage and when are claims settled? So your revenue coverage is the lower of either the average of your 5-year farm tax history or what you intend to produce during the tax year, whichever is lower. This amount is multiplied by the coverage level to determine the insured revenue amount. Claims are settled after your taxes are filed, and the next several slides will kind of work through that, because I think if you're entirely new to this can be a kind of a hard concept to just hear and to picture it yourself. And again, there's also lots of adjustments that are being made beyond your tax records that account for inventory from previous years or unsold inventory in the current year. And since we're working with tax records, there is a bit of a delay on settling claims. So when we base the claim on your taxes, you don't file those taxes. So you're producing a crop, you're planting a crop in the spring and you harvest it in the fall, but you're not going to file your taxes till the next year. So that's why there's there is a lag in the claim side of things. So this slide, this is where we kind of hopefully try to visualize a little more about how this policy works. Keep in mind your insurance agent loss adjuster would be working with you on doing these calculations. So that way it's not something you just do on your own. Your agent kind of works through this and they'll be asking you for this information to work through it. So the first step is determining your 5-year average revenue from your Schedule F tax returns and taking into consideration indexing, and also another component called expanding operations. So in this example, the expanded operation is the highest value. So you kind of, in this one, we're looking at just the history of your farming operation. Again, you have to have a minimum of 5 years of tax returns in order to be eligible, with the exception of the new and beginning farmer. And so when we look at the history, you've got basically several options of looking at your history. One is just looking at your tax returns. If there's some variable growth in your farming operation, something can be triggered called indexing. If you're outright expanding your operation, you've added some acreage, we can look at your base 5 years and add a factor to it to take into account that you're going to be expanding your operation. And all of this calculation at the history, we're looking at sort of the higher of everything. In this case, the expanding operation you qualified for in step 3. So that's why your 5-year history was 305,000, but your expanded operation was 335. So we're going to go to that 335,000. Now, the other side of it is we look at what you intend to do in the current year. And you file something called an intended farm operation report. And so in this case, for this example, this farmer is intending to plant onions, wheat, alfalfa, and potatoes. This producer has to let us know the number of acres they intend to plant, what's their yield. There's some record requirements on proving up those yields, and then what the producer believes the value to be for those commodities. Now, we talk about value, that's the expected value, and it can't be a made-up number. It has to be reasonable, realistic, and consistent with available local market information. But this is this is where, again, we're going to kind of do this comparison of the history and what you intend to do in the current year.
We just have to do that, you know.
Getting some feedback from some others, so please make sure your line is muted. So this is where we do that comparison of your history and what you intend to do in the current year. And this part is where what we call determining the approved revenue. And this is the lower of the farm's historic average revenue, that 5-year history, or the expected crop revenue that's shown on your intended commodity report. In this particular example, the approved revenue will come from the expected crop revenue intended report because that is lower. So that's why we're using the 301 as opposed to the 335. Again, the 335 came from the 5-year history plus the expanding operation. What you intend to do this year is a little lower than that, it's 301. So this is an underwriting control within whole farm. If you intended to do something less than what's in your history, and we always use your history, that would automatically put in a built-in loss. And so for underwriting control purposes, we use the lower of these two. Now the 301 wasn't your insured revenue, that's your approved revenue. And now we've come to the point where the producer, when they sign up for insurance, they select their coverage level. Again, that's deductible. And so for this example, the producer did 85% coverage level. So they took the highest coverage level. So 85% of 301,000 becomes the insured revenue, effectively the liability. This is the maximum amount that could be paid if there's a total loss, and also what the insurance premium is based on. Now you've gone throughout the year, and in this case, we're just for example purposes, again, I've re-shown what the intended farm operation report showed, what the farmer intended to do. There would be an intermediate step that's called a revised farm operation report that producers would submit after they've actually planted their crops. And so you can make management decision changes that might affect the number of acres you actually planted. But for kind of simplicity purposes, we're showing now at the end of the year what the actual sort of revenue was for these crops that were planted. So in this case, there's a yield loss on wheat and also a yield loss on potatoes. And then there's some fluctuation in the values of some of these crops where the price went down and you got a lower price when you sold the commodities. In this case, for onions, the price went down, and also for potatoes, the price went down. Overall, this resulted in your expected revenue of being only 100, or the revenue that you actually received from the sale of your commodities will be reflected on your tax returns, turns out to be $185,500. So compared to what you intended to do to what you actually received in revenue, you have a revenue loss of $116,500 if I did my math correctly. That isn't the indemnity, that's just what you actually have lost, because we're not comparing it yet to what your insured revenue was. But taking what you reflect in your taxes, your Schedule F, you're indicating that you had $184,000 of revenue for the year. When you compare that to the insured revenue of $255,000, that's where you then make the actual indemnity determination that there's a difference of $71,350. That is then the indemnity that gets paid. And just for informational purposes, below, we've kind of roughly shown what it would cost in this under this scenario. Now, this can vary depending on the commodities, can vary depending on the location where you farm. There's a lot of variables that go into a premium calculation, but this gives you sort of a ballpark of this amount of insurance, insured revenue being $255,000, you taking the highest premium or highest coverage level, so there's not as much premium subsidy. It's only 56%. So the producer is paying $6,600 for this amount of insurance. Whether that's expensive or not depends on somebody's risk profile. The next slide gives kind of a different perspective, that if the producer initially, or not initially, but in their application, they selected 75% coverage level, they have already built in a greater deductible. The chance of paying any loss reduces some, but they're paying lower premium subsidy because of, or they're paying lower premium because the premium subsidy is higher in the case of a lower coverage level. So the total premium for this case is $9,000, with 80% subsidy on that $9,000, the producer is paying $1,850. Now, again, they're insuring a lower amount of insured revenue. And in the case of this example, that producer would have, I guess for insurance purposes, done better. They would have got a higher indemnity than that person at 75%, but that person at 75% was paying a lower premium, would be paying less for the insurance. So that concludes my portion for Conniff talking about whole farm, and then Lacey will sort of take it over from here to talk about the microfarm pilot provisions.
Great, thank you, Ben. And can you guys hear me okay? Ben, you can tell me if you hear me.
Yes, I hear you.
Lacey.
Okay, awesome, thank you. So microfarm is basically a crop provision under whole farm revenue protection. And so that's why we spent this time really explaining whole farm, even though Annie initially contacted us to talk about microfarm, because it all just flows down with those same guidelines that Ben just covered. So that is the foundation for microfarm. Next slide here. Just clicking my arrow button to try to progress it, but Ben's running the show still. So, so really microfarm, like I said, is a policy under whole farm. It has that same sales closing date right now of March 15th for this coming year. Next slide. And it's a little different in that the cap for the revenue is $100,000 or less of total farm revenue. That is different for a carryover insured. That cap does go up to $125,000, but we don't have any carryover insureds. That means you would have had microfarm last year, and since microfarm is brand new, no one had microfarm.
What did I have before?
So right now that cap we're looking at is 100,000, and all those coverage levels are available, like Ben just showed you, that 50 to 85%. The main change is this was designed to reduce those record keeping requirements. So you don't have to track the commodities individually or the expenses for the operation. So we'll see some examples of that as we go through here. And another significant change is that this can include post-production activities, like value-added addition to the commodities, whether you're packaging them or even like turning your fruit into jam, that can be insured here. So, next slide. I'm going to cover just a few definitions that are included in the microfarm provisions that are kind of significant and differentiated from whole farm. Is that definition of carryover insured? We use that a lot when we're talking about insurance, and that most often means that you just had insurance the previous year. And really, when we're talking about microfarm, we're talking about if you had microfarm coverage the previous year. So again, this year it's brand new. No one is a carryover insured. When we're talking about whole farm, the commodity code and the commodity counts are a really big deal because that does dictate your premium discount and rating and things like that. So under microfarm, there's only one commodity code instead of different codes for each commodity. So if you look at our information online, you only see one commodity code there. This is all based on consolidated sales records. So there's a definition of that included here too. Those are the contemporaneous records that really document the sale of all of your commodities on the farm. And then the whole farm history period is 3 years minimum instead of 5. So when we're talking about whole farm, Ben's examples, we're all looking at 5 years. And this can be as few as 3. Next slide. So I'm just going to walk through the provisions. So you'll see these slides with the numbers on them here, and I'm just walking through everything, kind of pulling out the things that are notable that differentiate this from what Ben just explained under whole farm. So again, we have to have those 3 years of records. You're capped at $100,000. The operation is ineligible if it is vertically integrated or if there's another insurance policy for any of the crops. So that's significantly different than what Ben explained under whole farm, where you can kind of layer the policies together. Here, this is only microfarm is eligible for the farm if you choose microfarm. Next slide. So there are some required reports, but again, this is significantly less than the reports required under traditional whole farm. So an expense reduction factor isn't calculated since we don't look at expenses. So under whole farm, we do ask that everyone record the expenses and report those, because that comes into account at lost time when we're calculating the indemnity. So the sales records must be provided that account for all the commodities that were sold on the farm. Replant payments are not available. And then these different provisions down below here, you'll see there's lots of different exceptions and options within whole farm that really aren't available with microfarm. So there's not specific caps for livestock or nursery, for example. Next slide. And that just showed, we look at your tax forms. We do take all 5 years if you have 5 years of history, but it can be as few as 3. And then if you have less than those 5 years of history, instructions are provided to make up for those missing years and get you up to the 5 years of history. And indexing is available. So again, Ben explained that's if maybe your revenue is trending upward year after year as you're expanding, or maybe your trees are maturing, there's something like that. That will be taken into consideration. Next slide. So where this reduced paperwork really comes into play is that individual commodities are not required to have separate values. That example Ben walked through, we saw onions and potatoes and alfalfa, everything listed separately. So that isn't the case with microfarm. You just have one line and that's all your commodities on the farm. So we don't have to have expected yields and values for each individual crop. So you do certify the sales records that you submit, but those may need to be provided if your insurance provider asks for them. You also certify the number of acres that are being planted. And again, a grower may need to provide documentation for that if, or certifiable evidence if the AIP, the insurance provider, asks. Next slide. So the expected value, so when basically this expected value is like our current farm plan for the year, but since we're not doing it crop by crop, we do look at the previous 3 years to calculate what the expected value is for the coming year. If something has significantly changed with market conditions or commodity mixtures or production capacity, that can be adjusted. And then when completing the final farm operation report, I'm sorry, I have pop-ups popping up on my screen with the questions and covering the slides. The insured does have to provide the total value for all the insurable commodities that were produced on the farm that year. Next slide. So there is no commodity count under whole farm. We assume there is 3, or you have a commodity count of 3 for the purposes of that diversification discount and the premium subsidy selection. So you could have a lot or a few, it doesn't really matter. There will be a commodity count of 3 used in the calculations. Next slide. So when it comes to that post-production and value added, again, this is something that's unique to Microfarm. The revenue generated from post-production operations is allowable. Revenue from other sources, like if you have a farm stand and you also sell bottled water or something like that, that does need to be removed from the revenue. Next slide. So here's an example of the cost estimator. I ran this for Jefferson County, Oregon, specific to Microfarm, and assuming an average historic revenue or approved revenue for the year, depending on how this works, but of $100,000. So if you look, that top line is your amount of liability. That's the amount of insurance that would be provided. So if you had an 85% coverage level, there's $85,000 of liability or coverage. That total premium is around $10,000, and the producer's share, because of the premium subsidy, is $4,600. So if you remember Ben's slides, we talk about how that premium subsidy changes with the coverage level. So that 85% coverage level, there's a 56% premium subsidy. That goes up to 80% down at the 75 or lower percent coverage level. So you can see the liability decreases kind of evenly and fairly slowly with the percent coverage, but the producer's share of the premium does make a big drop between that 80, 85 to 75 coverage levels. So this is just to kind of give you a feel of about what it might cost for different amounts of coverage. This does change significantly by county. Not significantly, it does change some. So, you know, we look at rates, and that for all of our crop insurance products, the rate changes in different parts of the country, and we really look at that by county based on the risk and the loss and loss ratios that have historically happened over time. So the rate will vary. I think we looked at Pursuits in Jefferson, and they were close, but they were a little different. And that would change a lot from other parts of the state. The farther you go, you might have bigger variances in that rate. So this is just an example for Jefferson. Next slide. So here is just a screenshot of our website. I wanted to show you some interesting tools that are available. So along the top, there's a tools button. And after you click on that, you'll see options for summary of business, agent locator, actuarial information browser, a crop insurance decision tool, and a cost estimator. I really wanted to point out the agent locator tool. You can go in there and put in your location. You can select if you want someone who can speak Spanish. There's a few other things that you can select in there to find an agent who will cover your area. And then that cost estimator tool is convenient also. You can go in there. If you are not familiar with crop insurance, it might be easier to work with an agent for that, because there's some selections you make early on in this cost estimator process where you have to know the names of policies and kind of how to piece it together. Or you could contact me. I'd be happy to help you walk through it. But there's some great information in there, those two tools especially. And then I think we have a question slide coming up after this.
Lacey. So we do have a few questions. The first is from Carrie, and they are wondering, what does vertically integrated mean?
I'll go ahead and I guess I'll answer. I can see Ben is still on mute. Vertically integrated would be, we have technical definitions for it in our policies. But so I guess I'm wondering if they have a specific question in mind, but that would be an operation where maybe they sell to themselves. So if a producer has or an entity owns a farm and also owns a processing company, but they're linked together. So they're selling produce from themselves to themselves, if that makes sense, for, value added production or something like that. If they're doing it as one entity, that's different than having multiple entities that would be working together. And Ben, you can weigh in on that. Like I said, we have formal definitions of what vertically integrated means. But
No, I think that's a good way to say it.
It sounds like that might answer this next question, but I'll read it anyways. This is from George, and their question is, you mentioned that post-production activities such as making of jams or jellies can be included in revenue, but then stated that vertically integrated producers are ineligible. We're getting mixed messages from AIPs that vertically integrated do not qualify, but many small producers cut, wash, and package their products for farmers markets, such as making mixed grains, etc. Is this acceptable? And also, if a farmer purchases crops from other farmers and then sells them at their own stand or at farmers markets, is the revenue also covered?
Ben, do you want to jump in on those ones?
On the second one for resale, I don't know in the case of microfarm. Under whole farm, yes, that can be part of your revenue as far as your insured revenue, that you can purchase somebody else's commodities and resell it. As far as the level of risk there, it's not much. It's just more of a price thing. But in the case of microfarm, I don't know on resale.
And George, I can look that up and get back to you. Can always count on you for good questions.
Hey, Annie, is it okay if I ask a question verbally, or do I need to post it in the chat?
Please do.
Okay, thanks. Lacey and Ben, thanks for your presentation. I really appreciate it. And I apologize, I got interrupted there. So you might have addressed this in your presentation, but whole farm revenue has a number of revenue smoothing options available to it. What sort of changes are there in regards to revenue smoothing options for microfarm? Is it available? Are the same ones available, or is it excluded altogether? And I apologize again if you already addressed this. I got interrupted during the presentation.
My take on that, if you want me to pipe up, Ben, and I can confirm this. That was Drew, is that right? Who was asking the question?
Yes. Yep. Drew.
The way the microfarm provisions work is they are, in addition to the whole farm policy. In microfarm, it lists the provision, like special circumstances that don't apply, like the caps on livestock and different things and direct marketing. There's nothing in there that addresses the revenue smoothing options, but it does say that it does state specifically that indexing is available, and doesn't say that what else is available. So I don't know. I'll have to look into that.
Yeah, thanks. And you said that indexing was available under microfarm, or is not available?
It is available.
Oh, okay, great.
Indexing is, but I know there's those other options under whole farm where you get to
Yes.
leave out a year and they do all the different stuff to the history.
But it is really good to understand that just exactly how you taught us, which is that the whole farm provisions, you understand those, and then microfarm comes in and just adds a level of exclusions and different types of features to said policy. And that's a really good starting point for us to know how to explain it, how to coach people to understand it and all that stuff. And again, good job. Thanks for the presentation.
Yeah, and that did help me, Drew, because I did have some questions. I'm like, why didn't it address this in the microfarm provisions? And it's like, well, because that is the same as whole farm. If it's not addressed under microfarm, whole farm still applies.
Any other questions? You're welcome to unmute and put them in the chat or put them in the chat. I am also going to copy and paste. So Lacey's email is on that last slide, but would you guys mind, Ben and Lacey, putting your emails in the chat? I'll also put mine in case you have any questions for me and my organization. We are available, and we are also at hdffa.org. If you're ever looking for any other resources, we do all kinds of classes. We have one on drought strategies addressing drought and irrigation efficiency coming up in February. And then you also have, I know there's a lot of agents on the call today. As Lacey said, if you're looking for a crop insurance agent, you can do so on RMA's website. That is really helpful as well. So with that said, I just want to say thank you so much to Lacey and Ben for taking the time to present to us today. I'm sure they are happy to answer any other questions you have via email. My name's Annie, and I am with the High Desert Food and Farm Alliance. And I just want to say thanks for all of you for attending today. Talk to you soon, and I will send out this in an email to all registrants and a recording soon. So thank you so much.